Powell confirmed what we all expected. The Fed will ease at their next policy meeting. The question is 25 or 50. What I want to cover today is why now and what should investors expect going forward. But let me just start with our take on it, which is interest rate cuts will lead to a weaker dollar, which will be a tailwind for the U.S. economy and for the U.S. markets, especially given that we believe the U.S. was actually strong enough to not necessarily cut right now. So we're at a step with the market on that, but we don't think a 25 basis point cut matters that much other than symbolically. And would be surprised if they go for 50 right now, but let's jump right in and take a look. So Powell's remarks from Jackson Hole basically said that they're now moving back to their dual mandate where they were less worried about employment, which were at record low levels, and more worried about inflation. The inflationary number that came out, or the employment number that came out with the jobs revision last week, created a bit of concern, and it has people more worried about jobs and inflation, and the Fed reacted to that. But I think what you need to take away from Powell's remarks is what I put in bold here, which is what he's done all along, which is hedged his bet by saying he thinks the direction for rates is coming down. How much and how fast the market is probably way ahead of themselves, and they're going to continue to look at the data and worry about the risks. One of the risks that we see is that that if they cut too much, you could actually spur inflation back up and reverse it, because we think the economy is strong enough as it is right now. But we'll get back to that more at the end when we talk about what we think it all means. But why now? It started with the payroll revision that really changed the focus to jobs. But I think this number could be a little bit of a sloppy number for two reasons. One is weather, and three is the accounting for unauthorized immigrants. So the way the report is calculated from the Bureau of Labor Statistics is they use the establishment survey, which was 119,000 employers, which is about 1/3 of US jobs. They then benchmark that against the QCEW, which is the consensus of employment and wages, which uses employer insurance data, and that represents 95% of the workers. However, unauthorized workers don't necessarily get insurance, so that wouldn't be reported in that number, so it could be understated. The other thing it could be understated by is the fact that we had some severe weather problems around the country, which would take workers out of the workforce temporarily, and that does impact the numbers. So big debate on whether the jobs report is going to be revised considerably or not. Goldman Sachs and Ed Yardeni are in the camp that the immigrant issue is a big one. Citi doesn't believe it is one. I think it is a factor that should be counted in, but how much, given the way government reports numbers, I'm not sure I'd put too much stock into it. But directionally, there are issues going on that are furthering the Fed's concern. One is hires is still below pre-pandemic levels, and layoffs are below pre-pandemic levels as well. The other thing that the Fed's looking at is their favorite number, core PC, is projected to move closer to their target, and that number is coming out later this week. So in the Fed's view, they had room to move down, and I think they would prefer to do it. If they're going to do a modest cut so that they don't be viewed as being too political. If they do 50, already Trump's saying that it's going to be politically motivated if they make any changes to help the Democrats, instead of is this the right thing to do for the economy, which is, I believe, what Powell's looking at. But it is going to be politicized regardless, but I think they'll err on the side of 25, if I had to guess, unless the numbers get worse. And I would say that what we're experiencing right now is a normalization back to interest rate levels and other levels that are what we had before we started manipulating the economy more aggressively, really back to the tech bubble, but more specifically from the great financial crisis forward, where zero interest rates and the others really changed the look of the shape of the capital market structure. And I think gave people who, many of them have only invested in the last 15-year period of near zero interest rates, the wrong impression of what normal is. And I think we'll be shifting back to a more normal rate environment and a more normal economic cycle. And I think that's what the Fed's really trying to master, put through. Whether we get there or not remains to be seen. But traders reacted to Powell very favorably and priced in 100 basis points of cuts before year end. The 32 basis points estimate says that almost half of the people participating in this survey for Bloomberg said that they would see 25 and half said 50. I think 25 is probably the right number. I'm not sure there is a move in November. And I would suspect more likely another move in December if needed. But this is actually not dissimilar to what we saw back in last December, where the market got way ahead of themselves because the market wants to see multiples expand because they might be worried about earnings. We're not as worried about earnings. We think the US companies overall are fairly healthy. We think it's more the normal thing you have in the market where you have a lot of people who are highly indebted and not growing and not being able to do well, and a number of people who have managed their business well, run their cash, have cash, positive free cash flow, are able to make the investments they need to make to continue to improve productivity. So we think that the market's probably going to be wrong again on this. And if we get to where we need 100 basis points of cuts, given the strength of the economy right now, I think you could see that spur more inflationary tendencies. So we would be concerned if it went that far that fast, because it would mean one of two things. Either we're going to get a return in inflation, the economy is much, much worse than we think, and we don't see either one of those really the case right now. So we've talked a lot about different opportunities, and I want to just touch on a couple of them right now because it's really easy to be very negative given all that's happened and all that's coming with the elections, with the challenges in the Middle East and the like. But through all this, what I've said for most of this year is we're focused on three main areas of investing besides technology, which everyone else is. Defense would be one of them. And you can see one of the reasons why is we believed all along that the spending for defense was going to increase, because I believe the shift that's gone on over the last 12 to 18 months is as ESG emphasis has waned, the shift of defense being offensive versus being a deterrent has changed. And I think the acceptance of defense companies and portfolios will shift as well. But in the US, aerospace and defense is only 2.7, 2.8% of the S&P weighting. So these moves can create massive increases in stock prices if you get a little shift in momentum, and we believe that's going to come. But it's not just aerospace and defense. Mark mentioned demand for copper, and there was a report out by the IDC, and I don't have the name of that organization off the top of my head, but they said in their report that they see, that the S&P came out today with their view that copper demand for the next 25 years will be more than we've used in our entire history. So think about that for perspective. The amount of copper required for the next 25 years will be more than we've used throughout the entire history of the world. So we expect that there'll be a shortfall there that will be coming. Copper has been mixed in its performance, but it's starting to move up now. And the reason for that is that its enormous demand is in three critical areas: clean energy, data centers, and the deglobalization that's going on is in the reindustrialization that's going on. So one segment of the US stock market that's under 3% weighting is doubling for the top 5 companies their free cash flow for the last couple of years. And we think this is just one opportunity to look at. We think copper is another one where the copper demand is going to be growing at a dramatic rate. And as you talked about, Mark, earlier, finding copper that you can extract in a clean and labor-friendly way is very difficult. And that debate of the energy transition and the climate transition and the good and the bad that goes on with getting us there, we think is going to continue for some time. You also saw, as Mark mentioned, a report from Exxon today saying that they think the demand for oil for the next 25 years will remain at above 100 million barrels a day, which is where we are now. And that is with the push towards renewables continuing. BP says it's 75 million barrels a day, which would be 25% less than where we are today. And the IEA thinks it's going to get to 54 million barrels a day We don't see that happening. We think the energy transition is going to be more difficult. Jeff Curry, who is the head of commodities for Goldman Sachs, had a very good article in Barron's, and he views copper, oil, and gold as three of his favorite areas to invest right now because of the needs. And we think that's right. And I think most U.S. portfolios are not reflective of the weightings of these areas, because even the fossil fuel area is still about 6% of the S&P weighting. Defense is a low level, and materials is 4% or 5% of the weighting. So it doesn't take much money to shift into these areas as the needs continue to grow to have a big impact on the stocks, even though they haven't performed fabulously well this year. We think they're coiled springs ready to move. So we think that as we stand today, we remain positive on the U.S. markets and the U.S. economy. We think we are in a normalization process that is going to be a big adjustment for managers who haven't managed prior to 2008, that haven't seen what the world is like when you're at 4% and 5% interest rates is the norm, and that inflation running at normal levels, not being distorted by central bank policy or by the fiscal stimulus that comes in, that we've seen coming in, that distorts the economic cycles. So we think we're moving back to more normal economic cycles. So I think the hope that central banks bail everyone out is going to be overstated. We're also concerned that if the Fed gets too aggressive, and if policies get too aggressive on the cut side all around the world, that you'll see inflation, which would require a pivot back up to raising rates, which we think would be very detrimental to the global system and waste a lot of the work that's been laid to get the economy, global economy, back on a more sustainable path. We also think that if you cut too aggressively, it'll push people out of the cash positions and back into the markets, which would create a bubble, which you don't want to see either, although it'll be good if you're in it. When the bubble bursts, bad things happen, and that's how financial crises really happen, which lead to recessions. We think that the problems around the world in major economies still exist, and the numbers from China and Germany that we talked about since last week did not improve. They actually were reinforced by the reports on their economies since then. So we think that continues to drive capital back to the U.S. However, we think the easing of U.S. interest rates and the weakening of the dollar will help a lot of the emerging economies, and those highly indebted economies carrying big U.S. debts will make it easier for them to service. So that is a positive for the economy overall. But the big economy struggling is not. And we think that continues to drive capital back to the U.S. and again, sets us apart and does create some problems in other areas. We think the best opportunities will be in the areas that I listed here, as well as in healthcare, which I think is one of the productivity trends that will move. And you're seeing that with Ozempic and other weight loss drugs, what they can do to change lifestyle and outcomes that will allow people to be more productive in their workloads. And at the same time, we have NVIDIA's earnings coming up tomorrow, which have been a rocket ship. I think they're up 3,000% in the last 10 years, something like that. So the impact on the markets, the options are up or down 9% on NVIDIA's earnings tomorrow. So that'll be market moving. We do have the core PC coming out, and then there'll be further job reports before we get to the September Fed meeting. So I think we can expect more volatility to come. You also have a presidential debate potentially scheduled for September 10th, that we're starting to see the shell of economic policies coming out. We think that longer term, both parties' policies, if either party swept, would be inflationary, and that would put more pressure on the central banks to react. So I think as investors, we may want to hope for a sweep, for not a sweep, but for a divided government, regardless of who wins, because I think the policies of both parties could lead to inflation, whether it's Trump cuts blowing out the deficit on taxes, or some of the fiscal spending programs being loosely proposed by Vice President Harris would lead to equally, I think, bad outcomes for the deficit. So I think we're in a spot now where you can expect more volatility over the next couple months, but I would be cautious about getting scared out of positions, because following that, I think you'll see more rate cuts, and that'll put us on a more sustainable path. Along those lines, we do work with Ed Yardeni pretty closely. He was on CNBC yesterday. Again, at the close, he had basically an argument with the host, who was saying that Ed's views that the economy is too strong, we don't need rate cuts right now, is out of step with the market, and it is, but I think he might be right. I think the economy might be stronger than everyone thinks, and that has been our view at ARS as well. I think rate cuts were inevitable at some point, but I think the hope that we get too aggressive is misguided. I think we also have to worry about creating bubbles at a time that we have a very fragile economy, and we need to be careful about blowing the work that's been done to get us to this spot. Because as I mentioned in the past, globally, we put over a third of the global GDP in stimulus to the economy. So that is still working through the system and benefiting us. And to reverse that, when we have big spending needs coming, and to create more inflation is going to really create some problems that I think will go against the growth initiative. So I think this is a time that central banks need to be careful about easing too much, because I think the economy overall is stronger than people might think. And I think the Fed cutting can give us take enough pressure off the global system that can ease some of the strains and allow the system to move forward in a healthier way. So Mark, I'm going to stop there, and with one last comment. On September 17th, a week after what should be a presidential debate, we're going to be hosting a call with Andy LaPerriere, who is the U.S. policy analyst Washington policy analyst for Piper Sandler. Andy is an excellent speaker on this area, and I think it'll be a very timely look at what's going on in U.S. politics. So anyone who's interested in that around the world, it'll be September 17th at 2 p.m. East Coast time. So welcome people to join for that. And Mark, I'll wrap it up and open it up for comments.
That's great. And on that one, do you have a link for people to register, Stephen?
We're going to send a save the date out shortly.
Questions, comments on what Stephen covered?
Stephen, you made an interesting point that cutting rates might have money flow into capital markets, because if you look at sort of the 10-year and other rates, I think, the Fed might not have cut rates, but the market did. So, the things that affect mortgages like the 10-year, just take a wild guess, put some weight on how much you think, let's say a 1% rate cut, sort of money starts to flood into maybe some other places where you talked about mini
Well, I think
bubbles.
you bring up a really interesting point, because I don't think the long end comes down much from this anyway. It's the short end that's going to come down, that's going to push people out of cash to find other opportunities. And I think that will move money in large part into equities, because if they cut 100 basis points, equities are going to rip. And then I believe equities would rip because of that, because people are going to expect multiple expansions, even with weak earnings. And that will get the fear of missing out to come back again. And you'll see money shift out of the short term into the markets again. And I think that when we have those big swings, I think that will lead towards not necessarily the best outcomes there. So I do think that a 1% move would be way too much. I think you can get there over time, but I think the markets have reacted more to hope for multiple expansion than really looking at the economy and assessing whether it needs that much stimulus right now. And I don't think that a Fed cut solves a lot of the inequality problems and other problems that are being discussed in the debate. I think we have a housing problem that's a housing shortage, that the shortage is supply and demand issues that push housing prices up. But as you said, mortgage rates have come down already 1% from their highs. And I think without the Fed cutting, So I don't think the Fed needs to do much to get the outcomes that the market would like, because I think it's already happening. So I think that's a great point. The market's doing a lot of the work for them, but I don't think it's going to push them beyond, needs to push them beyond that. And I think the market hopes for that or more because they're having trouble finding good opportunities at these interest rate levels. And Andrew, as you know, we've been here before, and this is normal interest rates. The last 15 years is not, and we have a whole generation of investors who are not used to that. And I think also where this really is going to impact is a lot of the private investments that when you have zero interest rates, your ability to hold for longer is much greater, but raising money at 4% is a lot different than raising money at zero. And I think that's part of the shifts that'll go on that will adjust. And part of the reason why secondaries are increasing in popularity is people are getting out of the old stuff and trying to find a new valuation for old businesses that reflect the current environment. And I think that's what we're really getting to now. Mark, I think Adam's next. I'm not sure.
Adam, Jim. Yep.
Good morning, Stephen.
Morning, Adam.
Thank you for the presentation. Two questions, related questions. The first one is Bloomberg reported on the 26th of August that the rate cut would entice Chinese companies to drop almost 1 trillion worth of dollar-denominated assets, and that the yen would appreciate by 10%. Your view on that? That's the first question. The second question is, how will this impact the carry trade if it's already been priced in, maybe?
Don't know the answer to the second one because nobody really knows what's priced in there. It looked like some people think it was half wiped out and it's 50% of the problem it was before. Others don't know, and a lot of that will depend on how aggressive Japan gets on their rate hikes when we're cutting. So, and how aggressive we cut. So I think that could be I think currencies are one of the areas. If you had asked for black swans, I think currencies would be a gray swan right now. So I do think that is part of the problem there. And the first part of your question was if will China pull, $1 trillion of assets because of this? I don't know. And a lot of China's already taken a lot of their money out of the treasuries. I think they're left with 775 billion. Now down from 1.3 trillion. But at the same time, the interest rate differential of the US and the rest of the world is ECB cuts rates and other people cuts rates will drive more capital back from other areas. So we've seen it from the UK and other areas where capital is flowing back in. So I don't think you can just look at it in isolation and say, what's China going to do? And that's the driver. I think you have to look at how it really impacts the whole system. And that's one of the really interesting dynamics in the global economy is, everything is adjust. So we think about the market sold off massively a couple of weeks ago, but everyone who sold had a buyer on the other side who was thinking the market was looking very attractive at those levels. So that's the put and takes that we forget when we see these statements. So if they're selling, somebody's buying who sees it as a good value. So I think that I'm less worried about that there's going to be a buyer strike on the US given the strength of our economy.
Yeah, I would agree. Thank you, Stephen.
You're welcome.
Jim?
Stephen, the Fed embarking on rate cuts has not always been bullish historically. Why do you think this time might be different?
Because we're not in a crisis, and most of the time they've cut rates was in response to a financial crisis. It's simple. It's that simple, right? It's not that the economy is weakening that drives them to it. It's a financial crisis drives the economy into recession that the Fed reacts. That's really the reaction cycle that we've gone through, which is why you haven't seen it. But what the market's hoping for is rate cuts give you multiple expansion when they're worried about earnings growth. But I think earnings growth has actually been quite healthy too, right? What are we, 8-10% earnings growth for this cycle? Andrew would probably know the number better, but so I think that's the difference is I think they're cutting into relative strength. And I think when you cut into relative strength, you can spur the economy quite well. And certainly it's favorable for markets when they already have the tailwinds behind them. not all of them, not all companies in it, but certainly there are industries and companies that look quite attractive right now and will do well with their free cash flows. So,
Other questions or comments?
yeah, I think there's 6 trillion in money markets right now, is the answer. 5.2 or 2.5 of it, I think, is retail.
I put it in
money,
the chat.
so-
I threw the Fred chart in the chat.
Yep.
It's huge.
Yeah, it's big. The other thing is that's, is big is I think this data center spending and the chip spending is going to continue to go on. I think the view that that these companies can't continue to spend, I think they'll change their spending. I think there'll be a lot of money's lost. But we're going to continue to spend on productivity and innovation, and that's going to continue to drive companies forward. And I think that this is a time that's easy to get scared out of the market and scared out of what you're doing, or to get too over your skis. But I think we're going to see a shift to more normalization, that you get to the long end won't come down much, the short end will, and companies will start to realize whether their debt loads are manageable or not based on their cash flows, and that'll be the determinant for who wins and who loses. I think it's going to get back to basic, investing, not investing supported by distortions of economic cycles. I think that's the thing that nobody's really talked about much, is we've distorted the economic cycles for the last 15 years with stimulus, either zero interest rates or fiscal stimulus. And every time there's a problem, everyone demands that we bail everything out when we have to get to a normal economy being self-sustaining with modest support from the policymakers. And I think that's really what we're trying to struggle to get through. And I think it's hard for the market to adjust to that. We've had such a long time of free money.
Other comments, questions?
Steven, to that last point, just keep going on that theme. One industry that has never dealt with this, had to do it, is the venture capital industry. If you think of venture capital going through a correction, an analog to the market, it's a slow motion thing that's already been going on for 3 years and probably has 5 years to go. But the whole secondaries thing, a market for capital commitments actually exists, like people selling basically $1 for 80 cents. They haven't even invested it yet. It's unbelievable.
Yeah, I was curious if Jack Wyant's on the call to weigh in on the difference when he looks at how many companies would have not passed the screen from 20 years ago that pass screens now. I think it's a pretty significant number, and I think we're seeing that in some of the.
It's what's called a large number.
Thank you, Jack. But Jack, you've been down this road for a long time, right? There are a lot of guys who've come in that have lost ridiculous amounts of money because they didn't know what the other side was like.
This is a road that has stretches that go uphill and stretches that go downhill, and it's funny how they just sort of automatically follow each other. What goes up comes down, and what goes down goes up.
But this one went up with a little bit more stimulus than we've seen in any time in our careers, I believe.
Right.
So,
But Jack, when was the last time the venture capital market had to worry about one down round after another? It's been a long time.
Yeah, it has been a long time, and not frequently. Prior to about 1990, the VC market was essentially unknown. It was a small private club scattered about, mostly on the two coasts, and then somehow the world changed, and entrepreneurial ecosystem came into the vernacular, and lots of people tried to join in.
That's
So
why I got into it. It changed in 1999 when you could start a company and go public within a year. That's when it changed.
Michael Hammer, you want to talk about venture and going public, or do you want to talk about the Marcellus and Utica?
Oh, venture.
Okay.
And so as an LP, but also as a founder, it's kind of crazy out there, right? When you look at the money that's been poured into things like mobile pizza ovens, $500 million, things like that, right? And part of the problem is people chasing what they thought would be easy returns, but also the VC model, the 2 and 20 model is kind of broken because it rewards mediocre returns on the part of the GPs. And as I've said in other places, if somebody gives me a real 30% return per year, hell, I'll give them a 30% carry. What the hell? But most funds are not performing, right? And so at some point there has to be a rationalization or a come to Jesus kind of moment, because it's not a very efficient way of deploying capital. It's throw money against the wall and hope that things stick. And when I hear people say, oh, well, most of your investments are going to implode, and it's that one investment. That's a crazy way to invest. That's my rant, and I'm sticking to it.
So Michael, is it because of the 2 and 20 that it's a crazy way to invest? Because isn't oil field wildcatting similar?
Well, I look at it from the landowner side, and what's happening in the Utica is not wildcatting. It's the Chesapeakes, the EOGs, the Encinos, and they're not getting, for example, in the Utica, you're not seeing dry wells, people drilling in the hopes that it's going to return something. The geological work has been done. They know what's down there.
Right, but does this go back to your permitting comment earlier that they're giving it to the people who know what's down there and not to the people who might not?
Well, that's the permitting on federal lands is different than what's going on in the Utica. There's not a lot of federal lands in the Utica and Marcellus. So that's different. But getting back to venture capital, people haven't been doing their due diligence. And even going back to like the late 90s, the first wave, my CEO had me fly out to New York for a meeting with a couple, and I have to call them kids, who were pitching something. This was us being a strategic. And they literally came with a floppy disk and asked if they could borrow a computer to do their presentation. These were 2 college students. And part of their pitch was, well, we have a meeting this afternoon with so-and-so, and if you don't give us the money, we know they will, so we don't care. And after they left, I said, we'd be crazy to put money into them. The people they met with that afternoon gave them the 10 million. And guess what? They imploded. You could see that train wreck coming. And so, yeah, maybe I'm a little bit more stodgy in terms of how I view things, but the unrealistic, that one slide that founders show, the 5-year hockey stick, and everybody shows that same kind of hockey stick. And their estimates of TAM, the total addressable market, are wildly unrealistic. And, it's just, is there value in many startups? Yes, but there's a lot more startups that shouldn't be given a penny.
Okay. Other comments?
Jim Carroll, was your question on the money market cash based on it continuing to rise? Is it really coming off the sidelines?
Stephen, it's a controversial topic, right? Because if the cash comes out of your pocket into the market, then it has to go into my pocket that you bought the stock from. I mean, there are issues of enthusiasm. Are you hitting the ask rather than taking the bid? But the stock of cash in circulation doesn't change that much.
Well, I would say it's changed in that it's risen dramatically from, if you look at the chart, the US GDP.
In money market funds, sure.
Yeah, but US GDP in 81 was 3.2 trillion, right? I think household net worth back then was a fraction of what it is today. So I think we continue to grow as an economy, and I think money markets have been somewhat flattish because you only went there because you had to, or at zero interest rates, and then you tried to catch the 5% rates up. So I think what we miss when we look at some of the numbers like total debt and all that is in context where things were back then too. I think I started at Dreyfus in 81. I think the total mutual fund industry in the US was, I think it was 130 billion, and Fidelity had 13, Vanguard had 12, and Dreyfus had 11. So the numbers just blew up so much, and the economy blew up so much then that I think we have these big distortions when we look at the numbers and say things aren't really moving much. But you do see the money fly around quite quickly. In that, I think you will see money move aggressively for fear of missing out if the market starts to rip. And I think most people are projecting that the market, based on the rate cuts, should do well into the end of the year. But I would say it's going to be a volatile path to up and through the election before you see the real pop in late in the fourth quarter. Thank you.
Now, Stephen, what about money rolling out of money markets into CDs to get that extra time with higher interest rates?
Yeah, you got to lock up your money then, and it's just a question of how safe you are with that. And I think people will do that. I think you have your different types of investors, the ones who are into cash for cash purposes or into cash for parking. And I think you have to differentiate between the two. I think the cash that's parked there because they're concerned about the markets will move back in. I think the cash that's there for savings will stay. The other thing is these rates make it more attractive for the savers to increase their savings, so that you'll have some shift for them who try and de-risk as well, like insurers and others that now have real interest rates that they can take advantage of. So I think those are the shifts that you'll see from the savers versus the investors.
Any other comments?
Just a comment there. You can go sign up for Treasury Direct, buy yourself a Treasury bond, and instead of a CD, you can always sell it if you want to.
Yeah, I think liquidity is the other thing that we don't talk about as much that's starting to matter again. And I think people will value liquidity differently than they have before too. Because I think it's going to be pretty bouncy, but still in an uptrend for the US economy and for the US markets.
Any other?
Labor Day, Mark, they're worn out.
Fair enough. All right. Well,
We got Andrew Voss.
Andrew Vaughn. No, he can't leave without saying something.
That's not very kind, Mark.
No, something good, something useful.
Oh, well, thanks. Generally speaking, Stephen, what is the split between mutual fund allocations and ETF allocations on a percentage basis these days? And are mutual funds on the decline?
Yes.
In a dramatic way still?
Yeah, I think if you asked any mutual fund executive if they were starting a company today, would they start a mutual fund? The answer would probably be no. They would be probably doing it just ETFs. it's a very different liquidity profile for the investor, and I think they I think they would see the capital flowing there much more aggressively, but I don't have the number. ETFs are on the rise. I think mutual funds have been flattish to declining. And there's been an increase of mutual fund conversions to ETFs going on as well. That I think will be a trend that will continue for some time.
Thank you.
Mark, I think getting someone back on the geopolitics, whether it's Hamlet or somebody else, with what's going on in Russia and Ukraine and the Middle East would be pretty timely as well for upcoming events.
Yep. Adam, I'm going to point the finger at you a little bit. We do have, we think we should do a dual use focused event too. But yeah, geopolitics, they're in London, by the way. We have Control Risks is bringing two of their people. One is focused on the G, self-described Arabist, and then someone who looks after all global hotspots. Andrew, that's you just spoke. Michael Hammer, you want the last word?
Sure. It's actually a question.
Okay.
So the question about ETFs versus mutual funds made me pause for a second to think. I, by and large, have not seen 401ks that offer ETFs. My wife had a 401k that her company offered through Schwab, which allowed you to invest in anything Schwab offered. But are you seeing ETFs in 401ks more generally, or is that just not a thing?
I have not seen him yet, but I'm not as active in the 401k area as others. So Jim, do you know from what you guys have seen, both of your current and past firm, Jim Crow?
We don't track 401k activity very much because we don't have that many clients who are, paying attention to 401ks. We're dealing mostly with rollovers, IRAs. There's a lot of legacy in 401k business. It's slow to change. And I do know from talking to some of the ETF providers that it's that they have bruises on their foreheads from banging against walls trying to break into the 401k business.
I'm not sure when that change happens more aggressively. I think that one of the concerns is well, it's not a big concern, but how they do the record keeping becomes, I think, a little bit more problematic on that than it is on a mutual fund. That may be one of the issues for the administrator, but I'm not 100% sure.
Yeah.
I was just seeing, I saw Bill just joined. Bill,
Yeah. Hey, so sorry, I was delayed. Yeah, I'll weigh in a little bit. It's been a while, but I was sort of tangentially in some DC business a number of firms ago, and it's very much a real estate type of thing where you want to capture as much of that market as possible and keep it in as many proprietary products as possible. So if your provider is Fidelity or Vanguard or any of the other big mutual fund houses, the whole idea is to present a very attractive menu for the plan sponsor, but it's all proprietary product. So there are brokerage windows that you can offer as part of that, where then the participant can invest in other individual name stocks. They could choose ETFs if they wanted to, but that is very much their purview and their choices, as opposed to what the standard menu options are. And sort of further, is that the default now, some legislation came out, some number of years ago, is typically the time series funds where, yeah, exactly. The 2030, the 2035 funds, things like that. That's the default, where if the participant doesn't select anything else, their contribution will go into those funds as appropriate to their age. So kind of long answer to your question about ETFs is that I think that those who are offering the DC programs are going to fight tooth and nail to keep things as much in-house as possible.
Disruption.
Yeah, it's hard to cover the administrative costs. That's the reason they do it that way. The cost of running a plan is expensive, so they offer better discounts by using their own proprietary funds. That's the justification for it. So